stop waiting for interest rates to get back to 4%. In this market, that could actually cost you the home you really want. But what if I could tell you that you could get 4% right now and have the seller foot the bill for getting you to 4%? Hi there, I'm Joseph Nelson, and today we are breaking down the 2-1 Buydown program. This is a seller-paid program. This is the single best strategy for home buyers in Southwest Washington or even Northwest Oregon, I am licensed in both states, to lower their payments without sitting on the sideline. So what is a 2-1 Buydown? This is a temporary interest rate reduction funded entirely by the seller. In year one, your rate is 2% less than the going interest rate. In year two, it is 1% less. And in year three, you move to your original rate that you bought at, which right now, this is March 30th, 2026. We're looking at a hair over 6% right now. If we got a rate at 6.1%, your first year's payments would be at 4.1%. The second year payments would be at 5.1%. If we were to do the math, the seller puts the cash in escrow at closing, and that accounts for the difference in your mortgage each month. So let's look at the numbers. Imagine we find a home for $500,000 and we lock in a rate of 6.125%. Normally your principal and interest payment would be $2,431 a month. But in year one, with your interest rate of 4.125, your payment drops to $1,939 a month. That's $492 back in your pocket every month. Year two, 5.125%. You're still saving $254 a month. The seller has already paid at closing nearly $9,000 for you to get this buy down. So what's the strategy? As we see inflation cools and gas prices come back down, most economists expect rates to trend down over the next couple of years. We should think of this buy down as a bridge to when interest rates become lower. You get a discounted rate now while the market is very buyer friendly. And then you wait for your window to refinance to a permanent 30-year rate. If you refinance early, a portion of that seller paid credit goes back into your bank. It typically gets credited towards principal reduction or closing costs on the new loan. So there is a catch, and I want to be 100% transparent because I believe in transparency. Even though the initial interest rate you're paying on this example is 4.125% the first year, you still must qualify for the full 6.125%. The lender wants to know that when the rates normalize that you're going to be able to afford to make the payment if you do not refinance. So this isn't a loophole, it is a safety net. I want to add a little bit about how friendly the market is right now to buyers. I'm getting almost every deal into contract that we make offers on. That's not going to be the case when interest rates actually get down back into the fours. We're going to see another feeding frenzy, and it's going to become quite difficult with multiple offers to get homes into contract. We have so many pent-up buyers right now who have under 3% mortgages. They are waiting for interest rates to get closer to that 3%. We'll probably never see that again, but if we hit in the mid fours or high fours, all these people are going to be back in the market and doing what they've been wanting to do for years. So I am making the case for using the 2-1 Buydown to make your payments more affordable and give you a bridge to refinance when the rates come down. This will make buying a home much easier with less competition. And you can always refinance. There will never be too much competition to refinance. So with that, let's put the 2-1 Buydown to work for you and get you off the sidelines and back into the starting gate. And with that, I'm Joe Nelson, and I will see you on the next tour.